Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, as always, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us here as we go through a little bit of volatility in the market. It's certainly not the first time that we've seen it, one of many along the way as we've been doing these markets for a very long time now. But very happy to have you along. We'll kind of walk you through some of the developments that we're seeing and what that might mean for our portfolio. The two things we're going to talk about today: we're going to talk about credit spreads and how they are impacting the markets and which direction they're heading. And then we're going to take a look at really one of the bright spots out there that we'd really like to shine the bright spot on, which are international markets and some potentially developments there in the right direction. So we'll jump right in and talk about credit spreads. And that's a fancy term, but I'm just kind of give you some back to what it is we mean when we say credit spreads. Okay, so you really always start your investment comparison, or at least we do in the industry, by comparing things to the U.S. Treasury, right? The safe borrower. Every incremental borrower there has a higher interest rate than Treasury based on their risk. The closer you are to making a good, solid credit worthy payer and more confidence by the investor they'll get their money back, the closer your interest payments will be, or your interest rate will be closer to that Treasury bond. And the more risky you are, the further that goes on out. But the ratio, or the amount of extra interest, rotates through time. Just like with the stock market goes up and down, bond investors adjust wildly over time as they get more risk on and willing to take on those lower grade borrowers for that extra income, and until it gets to a point where they want to shed that and begin to go the other way. And that investment direction, as they gravitate towards the safer borrowers or the riskier borrowers, can really lend its way into the broader markets. It can change the borrowing power for companies. What you could often have are cycles where credit spreads are rising, can become a virtuous negative feedback loop. As spreads begin to increase, that makes those companies in an incrementally worse position, which can then spook investors a little bit more. That's why we find them to cycle over time as opposed to be stable. But they've been going in the right direction for a very long time, and reached generationally low levels as we went through 2023 and 2024. So I want that context as we take a look at where we are now. We've got three things on this panel: the S&P 500 going back over the couple of years. We're looking at high yield. So these are the riskiest borrowers, ones which a high degree of likelihood of going through a bankruptcy in the near term, not like the next month, but over the next few years. And then AAA, which would be your very safe borrowers, of which there is only a handful of companies in the entire world that hold that AAA. And those charts measure that spread. And if you go back and look into 2022, you'll see that that high yield spread was moving up fairly rapidly. Those are the cycles we're talking about. As they begin to move up, they kind of work each other higher. Look at the green line that's down sloping back in 2022, 2023. What you'll notice are those spreads begin to trend lower as the market, the S&P 500, was making its low. And that gave us some insight that investors on the bond side were getting at least incrementally more positive. And this was a good thing. So where are we right now? Again, we are really, really low territory, but we're moving in the wrong direction. As of this point in time, when we record Tuesday, mid-March, we're just back to the where we were in late 2024. We'll be concerned if we begin to move into new territory and could have some action that could spark wider activity. For the time being, our fixed income portfolios, how was your money invested? We have been rotating that into the safer side. We really didn't find enough extra interest to warrant the extra risk. So we're kind of batting down the hatches for now, letting that play out. And hopefully one day we get fatter yields as those spreads move higher. We've got greater opportunity to redeploy that capital then into more opportunity. And hopefully that comes into the coming months. So that's the fixed income side. I'll pass the baton over to Andrew for the equity side.
All right, thanks, Adam. So shifting from credit spreads, now we're going to look at international markets. That's a topic that you haven't heard us discuss in quite a while. Foreign markets have really been lagging domestic markets for several years. It hasn't really paid to put a lot of exposure into international markets. The way that we evaluate when to start looking outside the U.S. borders for investment opportunities is recognizing that there can be some higher risk to foreign markets. And so to take on that risk, we want those investments to be outperforming whatever type of returns that we could be getting by staying stateside. And so that's one of the screens or filters we run through is, are foreign markets outperforming or underperforming the S&P 500? And when they're underperforming, we just assume to stay at home and just focus really mostly on domestic markets, keeping some international exposure for diversification's sake. Now we're starting to see a little bit of that change. And so if we look at this chart on the top panel, we have an all country world index. So looking at all the different international markets, and in blue in the bottom is looking at that index compared to the S&P 500. When that blue line is going lower, it's telling us that these international markets are underperforming the S&P, underperforming domestic stocks. When that line is going higher, it's telling us that foreign markets are starting to outperform the S&P 500. And so if we look at the far right side, looking at the 2025 data, we can see that blue line is starting to creep higher. In fact, it's actually been rising quite steadily, at a much faster clip than we were seeing in domestic markets, outperforming, actually being positive, while many markets in the US are actually negative year to date. So this is telling us that we are starting to see investors shift focus internationally, looking for opportunities there as expectations with changes in the US dollar and international policy. And there's many different catalysts that could cause this shift, but it's one that hasn't happened in quite a while. And it's still very much in its infancy. We could just be seeing just a kind of counter rally in the relative performance there, something that we do see throughout the last 10 years. Or it could really be something, a major shift change to where we could start seeing something that was likened to the mid to late 2000s, where we really were seeing international markets really get some strength and outperform domestic markets, giving investors and those with a keen eye good opportunity to seek returns and good diversification beyond just what we're finding here in the U.S. market. So this is something that we're really keeping a close eye on, really trying to look for. And it also provides opportunity when we start seeing domestic markets weaken, giving us those opportunities to look for other opportunities for risk, other opportunities for reward, and just trying to keep the portfolio diversified as we start seeing a little bit of weakness here in the S&P 500 and just the general market for U.S. investors. So we're encouraged to finally start being able to talk about international markets, being able to find some other opportunities. And it's something our team is pretty excited about. We hope it's something maybe that could continue. If not, then we'll shift focus again, always trying to stay nimble on your behalf.
No, absolutely. And well put. And, our opportunities for international were pretty much constrained to currency hedged Japanese equities, which is a pretty small and unique way and something you can't put in real big chunks of the portfolio. So broader opportunity sets, really healthy. I love that you referenced the 2000s, which was the decade where I really cut my teeth. And there were some good parts about that. Most people remember a lost decade for the S&P 500, but if you were willing to be dynamic in adjusting, you were able to have at least some decent returns out there where people stuck in just an S&P 500 got totally left behind. So who knows? Maybe we're going into one of those environments, or maybe we are, as Andrew put it, in a counter trend short-term period. But we will be watching that every week as one of the main indicators. So hey, so glad that you joined us. I really appreciate it. If we can be of service, please don't hesitate to give us a call, 800-928-4001, or scan the QR code and do it electronically. Thanks again and have a great weekend.